Holy smokers, folks. This is no longer any type of jokas. We've got massive moves in this market and we're just getting started, folks. Okay, we're going to talk about what's going on out here. Obviously, some massive moves have started here today. We'll talk about where this market's headed from here, what's going to happen. I'll explain kind of that in this video at the top. We'll obviously talk about Palantir. So obviously 2 days ago, I put on this 2x leverage against Palantir stock, and that was up over 15% today. So we'll talk about what's going on with Palantir, how big of a deal it is or isn't in regards to that matter. So that's going to be all here at the top of the video. Also going to talk about Tesla and Palantir also in regards to how much downside's ahead for those two particular stocks, okay? We'll talk about the market and some scary stuff, man. So much scary stuff that reminds me so much of 2018. It's insane, including what happened today on October 3rd, 2018. Almost a very exact thing that happened today. And today's October 3rd. It's ridiculous, man. It's creepy how, insane this is at this point in time, okay? So we'll get into all that. Then I want to go ahead and react to the beginning of closing bell here today. There was some great commentary, I thought, back and forth here that I want to definitely react to around AI spending, where the market's headed, things like that. So definitely looking forward to reacting that with you guys here today. So busy, action-packed video. Man, it's been so busy lately for me. I appreciate you guys joining me. The one thing and one thing only I need from you, if you could please just hit the like button. If you could just make that thumbs up button glow for me, you are my hero. And if you already did it, you're a double hero, okay? If I didn't even need to ask. Additionally, if you want to see more of my videos in the future, make sure you're subscribed here to the channel, okay? Alrighty, so right off the bat, where do I want to start? Let me start with Palantir. Let's just go Palantir first, and then we'll go from there, okay? Listen. Palantir today showed you how fragile this stock really is at this point in time. This news came out here today. Palantir and Anduril's battlefield communication system has issues, says the Army in a memo report. The modernization of the U.S. Army's battlefield communications network being undertaken by Anduril and Palantir, among others, has fundamental security issues and vulnerabilities and should be treated as very high risk, according to a report by Reuters. A September memo from the Army's Chief Technology Officer, that's a high-ranking individual, about NGC2 platform that connects soldiers, sensors, vehicles, and commanders with real-time data indicates some issues with internal product, according to the report. Quote, we cannot control who sees what, we cannot see what users are doing, and we cannot verify that the software itself is secure. Okay. As Army Chief Information Officer, Mr. Leo, publicly stated, the security review process during the experimental phase of NGC2 functionality as designed with findings mitigated immediately prior to field integration with first division level event, which proceeded successfully without delay, said a Palantir spokesperson. Palantir software, which maintains Impact Level 5 and 6 authorizations, provides the Army with visibility to rapidly conduct comprehensive security assessments across the NGC2 ecosystem. No vulnerabilities were found in the Palantir platform, says a Palantir spokesperson. The Department of War and Anduril did not immediately respond to request for comment. Where do we start here? Okay, listen. This is not a big deal for Palantir, and it is a big deal for Palantir at the same time, okay? At the end of the day, Palantir's business is absolutely booming, not just with the government side, but in many different government areas, and is also booming in the commercial space, right? And why was I buying Palantir stock at $6, $7, $8 years ago and loading up on shares? Because of the commercial opportunity, not because of anything military related. With that being said, here's why it is actually a big deal for Palantir stock. Palantir stock's valuation has gotten so insanely rich at this point in time that if you're talking about just a percent or two of revenue growth being, let's say, not there in the next quarters, the stock's going to get crushed. This is a stock that every single quarter has to show basically several percentage points of revenue growth acceleration, quarter in, quarter out. And as soon as people start to sniff out revenue's about to start to decelerate, and let's say go from a 50% revenue growth rate down to 45, the stock's going to get obliterated. And so what happens is you see on a day like today, just a little something in regards to Palantir, and something negative, and the stock goes down huge, right? And obviously a 2x leverage against Palantir is up 15% today. That's a stage we're at this point in time in regards to Palantir. So if you get any other bad news or just a little worrisome here or there with regards to Palantir, the stock will continue to get hit. And think of it like this. When your valuation gets higher and higher, and when I say valuation, I'm not talking about your market cap. I'm talking about your P ratio and your forward P ratio. The higher and higher it gets, the more ridiculous it gets, right? Palantir trades at like a 300 forward P or something just ridiculous, okay? The higher and higher it gets, the more fragile you are, okay? So imagine like if Palantir today was trading at a forward P of 25, let's say, then imagine Palantir is like a piece of steel. It's like impossible to break that thing, right? Because you look at the growth rates and you say a forward P of 25 is like a joke, right? Like that's insane, right? Let's say they were trading at a forward P of 55 today. And you say it's like a strong 2x4, right? Like that's going to be hard to break. It's possible, but it's hard to break because the growth rates are so strong. And then you have forward P, if you had a 50, 55 with the growth rates, it's actually not that high, right? Now, suddenly, let's say we take it up to a forward P of, let's say 100, 120. Now, suddenly Palantir becomes like a strong stick, right? Like from a tree, like a strong stick. Like, yeah, you can break it, but you're going to need to still take some effort. When you're trading at a forward P of like 300 or whatever Palantir's at right now, you suddenly turn into what? You turn into a glass. And all it takes is one little drop and your glass is shattered everywhere. That's what happens in the stock market when P ratios get way insane, okay? Then suddenly it's not hard to break you at all. It's very, very easy at that point in time, okay? Now, let's talk about Tesla and Palantir in general, and then we'll go back to stocks in general and talk some about that, but I just want to continue with the Palantir talk here, okay? Let's talk about some other stocks real quick, because there's not that many I want to speak about. Shopify was up big here today. That one continues to see massive momentum. Another 6.5% move for Shopify here today, and this is an unbelievable one from those lows back in 2022. It is now up over 500%. So Shopify continues to show a lot of momentum, right? And don't be surprised if that one continues to do well. TSLZ was up pretty nicely here today, over 3% upward move because Tesla was down. Other than that, there wasn't that many extreme moves. In big tech in general, MU continues to show strength, 2.2%. Like I said with MU, like if there's ever a year, MU should go to over 200. It's this year. If MU can't reach it this year, I don't know if MU can ever reach it. Like they just got everything going for them. Their numbers are a banger. Like this is the year to do it, MU. If you're going to get to that 200 plus level, do it this year, okay? Or let's just call it in the next 6 months. Palantir was a big downward move here today. AMD was a downward move. Netflix was a downward move. The interesting thing here is we haven't even seen like the market get hit. So if that happens, just understand these stocks will go down a lot more. Before we get into Tesla and Palantir and downside there and go from there, pinned comment down there if you're looking to apply to our own private stock group, private wealth group. If you want access to just see the stocks I was buying and selling here today, you can join my Patreon. That is available. That will be the second pinned comment down there. It's also linked in the description area. My private group, on the other hand, is all my course curriculums, private Discord chat, all that good stuff, plus access to 1000xstocks.com. Patreon's more for if you just want to see how I build up a portfolio. You want to see the stocks I'm buying and selling each week. I made moves today in the portfolio. I bought 3 stocks. If you want to see what 3 stocks those were, that will be the second pinned comment down there, and that will be the in the description area as well. But it's different than my private group. My private group's like a whole different tier above that, right? So as far as potential downside for Tesla and Palantir from here, here's what I posted on X here today, which my X is always linked in the description. I said, worst case scenario I see for Tesla and Palantir, if the Nasdaq goes down 10 to 15% this fall, which is nothing crazy, like that would just be a decent sized pull down, right? If that was to happen, Palantir worst case scenario goes 115, Tesla worst case scenario goes 325, in my opinion, right? Which is still a lot of downside from here, so do keep that in mind. But that's worst case. I said, if we have a 20% plus QQQ down move, right, which is unlikely, by the way, but that is possible. Like we did have that in 2018. I don't think this one's going to be as severe if we do get a pull down this fall, but if it was, you'll see Palantir go under 100, and you'll see Tesla go under 300. So do keep that in mind. But that's if you got that major pull down from here, right? So do keep that in mind. You know, and would I hold all the way to the lows as far as PLTZ or TSLZ? No, No, I'd be out of those way before that, right? I'm never, with these hedges, I want to make a lot of money in a quick amount of time, but I'm not looking to like perfectly time it out at the bottom. Like if I can, whenever I get into a hedge, if you give me an opportunity to make 40, 50, 60, 70% in a quick amount of time, in let's say a month or a couple months, I'm taking that. Peace. I'm good. I don't need to make, I make the crazy money on my long positions, right? Like early days when I was an investor in Tesla and Palantir and these sorts of companies, ELF that make me 1,000% gains, 2,000% gains, 2,000+% gains. Those are where I make the game-changing money, the life-changing money, if we want to call it, right? Metastock. How much have I made on Metastock? 500% or something ridiculous, right? 7 figures plus on Meta. That's where I make the life-changing money, the portfolio-changing money is on long positions. Where I make that good in-between money is on hedges in time periods when the market gets way out of control. And that's certainly a time period we've been going through. It's been way too risk on for way too long now at this point in time, okay? Now that brings me up to 2018, right? Because I posted this inside the private stock group last night. I said, this whole year I've been talking about how many things remind me of 2018. In 2018, we had the last high on October 3rd. Today was October 3rd. Imagine how creepy it would be if the market starts going down next week and just keeps going down. Might not happen, but would be wild. So if you look at this, October 3rd here, right? The market actually closed somewhere around here roughly. So it reached a high intraday, and then we actually started to downtrend there, which is very intriguing because let's go ahead and let's take a peek at the S&P 500 on a 1 day. Are you kidding me? We reached the highs midday and then we finished much lower. Exactly what happened. This was a close on October 3rd. We fell off a cliff there, right? Came back a little bit, closed a little bit higher than where we were here. It's the exact same thing. It fell off a cliff, right? Came back a little bit, closed higher than here. The same creepy, man. That's all I'm saying. Like, it's just another thing on another thing. So we'll see. If this is 2018, the market will start downtrending next week. If the market doesn't start downtrending next week, then maybe it's not 2018, right? Maybe we can throw that out and say, hey, you know what? Maybe it's not 2018. But if this market starts downtrending next week, whoo, like, how are you going to say anything? You know what I mean? Like, that's just crazy. All right, let's react to some of this from closing bell
New York
today.
Stock Exchange. This make or break hour begins with stocks on the march, more records falling, and investors asking a very simple question. How long can it last? We'll ask our experts over this final stretch. Let's show you the scorecard. With 60 to go in regulation, neither the government shutdown nor the lack of a jobs report doing much to disrupt the major averages today. We're green on the Dow and the S&P. Nasdaq's got a little bit of work to do. We did have the 31st record high of the year today, and we'll follow that. Apple is close to its own new closing high. It's first in nearly a year, and that's despite a downgrade for that stock today. More questions about a potential AI bubble with more notable names weighing in. We'll tell you who in just a bit. It takes us to our talk of the tape, this rally, and how far it can run with earnings not that far away. Let's first get the very latest from D.C. Our Emily Wilkins on the Hill as a key vote taking place as we speak. Em?
Hey, Scott. Well, yeah, right now, senators are voting once again for the fourth time on that stop.
So we brought up Apple. Let me just mention something in regards to Apple real quick here. Listen, iPhone has started out very hot as far as this cycle selling, the iPhone 17. Here's the deal, though. A lot of people, including myself, automatically get the new iPhone every single year as soon as it comes out, right? And I do that because I take a lot of pictures of my kids, right? When they're playing, I got 3 kids. Like, if you ever had kids, like, you're always taking a lot of pictures, videos, and doing stuff, right? Additionally, I'm on social media, so I always like to have the greatest device since I'm on social media. But I can tell you, if it wasn't for that, I wouldn't get the new iPhone every year. I can tell you that. It's a business write-off for me, so it's easy peasy lemon squeezy, no different than getting a new MacBook Pro every year. So you can't always get the best understanding if the iPhone's going to be strong nowadays based on really the first month sales. We'll see as the next few quarters go along if the demand stays really high. If it does, then that means a banger for like everybody. But that first month sales is tough because, like I said, so many people, like, it probably didn't matter what Apple announced. As long as it was a little better than the last one, I was going to get it. And there's a huge segment of Apple customer base that is exactly like me. They're just going to always get the newest one as soon as it comes out and then sell their old phone.
Measure that would reopen the government, keep it funded through November. However,
so what that means for Apple stock is Apple stock is now priced in a lot of this early demand. Actually, it's priced all of this early demand for iPhone 17 in. So if sales numbers start to, let's say, weaken over the next few months, and let's say those wait times go down considerably, right? And all of a sudden it's like, okay, maybe the demand's not as high. Apple stock will get hammered in that situation, which will then hammer the market as well, because we got a whole other situation going on in regards to the market. Now, if demand stays insanely strong, wait times keep being pushed out for the new iPhones, then Apple can continue to roll higher and maybe go 275.
While the gavel has not fallen, which means the total is not official, we are not seeing the 60 votes needed to get this over the finish line. At least 41 senators have voted against, which means unless some of them change their votes, we are once again headed into a failed vote. And the shutdown is then set to continue throughout the weekend and into Monday. Now, we're watching to see if any Democrats are going to join with Republicans. We're seeing the same three that we've seen previously, which suggests that Democrats are holding firm, trying to get some sort of a deal here with Republicans, likely on that Affordable Care Act premiums, the tax credits that help a lot of Americans access those for a lower cost. That's something that impacts blue states as well as red states. And so that is one of the main things. We know there are bipartisan negotiations, but as Speaker of the House, Mike Johnson, pointed out today, those could take weeks or months to complete. So trying to find a faster way forward on that. Obviously, as you noted, jobs numbers missed today. The pressure's only set to increase as the shutdown continues. A couple weeks from now, we're going to have potentially missed CPI numbers, missed PPI numbers, and very critically, a missed paycheck for a lot of government employees as well as members of the military. So they will be back next week. We will see what, if any, progress is made then. But right now, it is very much feeling like a stalemate up here on Capitol Hill. Scott?
The latest. Emily, thank you. Emily Wilkins. Now let's welcome in Sol.
I don't see the Democrats giving in anytime soon, unless they get what they want in regards to the healthcare related stuff. Why would you? Like, literally, why would you, if you're one of those Democrats, why would you give in? Doesn't make any sense. Like, you're going to continue to hold out for the stuff you want there and let the cards come crumbling down on Trump's head. Like, that's just crazy. Like, of course, like the fact that people are expecting them to just give in, like, no, not until they get what they want. Right, in regards to that healthcare related stuff and a few other things. But yeah, that's, look into the matter a little bit more is what I would suggest for folks. I really looked into the matter a few nights ago and started reading up on it, from kind of both sides, like the Republican perspective, the Democrat perspective, and then like in between, like a, indifferent perspective, and just kind of like what's going on there, what's the play for both sides. And I don't know why either side would give in right now. Like, it doesn't make sense. I think this fight's going to go on a long time. If one of the sides gives in, it's pathetic.
Alternative Asset Management's Dan Greenhouse. He's here with us
if one of
at Post 9. It's good to see you. The market obviously doesn't care much yet.
Neither do I.
About what's happening in D.C. How do you see things?
At the end of the day, Democrats should not give in. They should make Trump give in. Let Trump give in once the market starts crashing, right? Let this continue to go on. Market starts crashing. Eventually, Trump will give in. Like, play that game.
Progressing from.
I don't think this matter. We was on the other day with Carl, and I said I refuse to play this game. We've done it. You've been around as long as I have. We've been playing this for 10 years now, 15 years now, and obviously shutdowns haven't happened every time.
This is the issue. None of these Wall Streeters are taking this shutdown serious, and this is the only shutdown I've ever taken serious. All the other ones in my 17 years of being in the stock market, who cares? Like, nothing. This is the one they should actually be paying attention to. This is the one they should actually care about. And all these Wall Streeters just brushing it off as like, no. I'm like, dude, this is the one. Like, come on, this is the one you should actually be fearful of, because this is the one both sides should stay, stick in the ground and not make a move for a long time. I'm like, I wouldn't be surprised if it went for months. Like I said, if one of the sides gives in so easy, pathetic.
I'm that the shutdown fight has arisen, but nonetheless, I refuse to believe that this is a meaningful impact. Anything that happens in the short term will be reversed in the medium term. Missed paychecks will be paid in arrears, et cetera, et cetera. So in terms of the government shutdown, I refuse to care.
Okay, so what do you care about right now in the market?
Well, I mean, I care about fundamentals. I care about inflation. I care about the Federal Reserve. I care about earnings.
Yeah, he should care about this. That's a problem with these Wall Streeters right now. Right now, they're like, oh, I don't care. Dude, you should care. You know why? Because this could go for a very long time, potentially. Unless one of the sides is really weak, unless Trump gets really weak here, the Dems get really weak, this should go for a long time. Months. Not days, months. Additionally, think about it from this perspective, right? These federal workers are going to be out of pay. That's going to hit the economy. There's a massive quantity of them, right? Potentially hundreds of thousands. What are those folks going to do? That's a tough position to be in for quite a while, right? Imagine if this goes for several months. And of course, you're supposed to get back pay eventually, but dude, if this drags on a while, that's going to hit the economy. You think those people are going to go buy new iPhones when you're out of pay, out of work? No, of course not. So, that's something that should be taken very, very serious.
Going to get better earnings really soon, right? Banks are going to kick things off not too long from now.
Quarters ended. We're now turning.
Plus, if you're Trump, I wouldn't worry that much about a short-term stock market correction crash. And the reason being is, what does Trump really want? He really wants interest rates a lot lower. How do you get the Fed off their butt and start lowering interest rates? I'll tell you exactly how. Crash the freaking market. As soon as you do that, the Fed goes into panic mode. Nothing in this world panics the Federal Reserve as much as the stock market goes down a bunch. Nothing. Send the market down huge and watch them panic at the Federal Reserve. And believe me, Trump will suddenly have Fed funds rate exactly where he wants it.
Attention to what ultimately matters.
But when the market's at all-time highs, you think the Fed's scared of anything? Oh, the market's at all-time highs. They always look at even if they don't want to admit it, they always look at the market. Send the S&P 500 down 10%. Watch how they start to get scared. Send it down 15%. Watch them start to panic. Send it down 20%. Watch them take the Fed funds rate down to 1%.
I think earnings will be fine. There continues to be this concern about the consumer. It's sort of like the worry that never goes away. But all the companies that recently reported, Dick's, et cetera, that have reported in the last month, have all said some version of the same thing, which is that the consumer's fine.
You pretty much just stay with what's been working then?
Yeah, for some time, that's been my argument. The theme is so dominant. I think the better conversation, and I don't mean that disrespectfully about everybody focusing on AI, but I think the better conversation is, okay, we've exhausted tier one, NVIDIA, Broadcom, et cetera. Everyone knows about that. And to a large degree, you've exhausted tier two, the derivative plays, the Vistras, the Vertivs, the Eatons, the Trane Technologies, et cetera. What's the tier three that you should be looking at? It's probably in the power space, names that are not yet seeing the type of investor attention that's being paid to certainly the tier one, if not the tier two names as well. That's probably a better conversation.
What is it? Power? Come on, dude. Power's been played out. That was a 2 year ago play, a year ago play. No. What are we talking about here? Software stocks. That's the next play. That's the next AI beneficiaries, right? And if those companies don't benefit, then the whole system's done. We're all screwed as far as the whole AI budgets and all that will start to collapse. But anything software related is what you'll start to see really benefit in 26 and beyond. You should see Salesforce start to benefit quite substantially. Adobe, right? Companies like that. Meta should continue to accelerate their business, or at least have their business in a good place. AWS should see a revenue growth acceleration quite substantially in 26. If we don't, we got actual real problems in AI, and you're going to see NVIDIA's revenues go down substantially in 27, 28. You need to see people start to really make big money from this. That's what we should say. And so that's where you want to look for opportunities. Salesforce, Adobe, even Meta, right? Even Google, stocks like that. That's where their big opportunities are. Mr. Softy could maybe benefit a little bit. Amazon should benefit massively. So that's where to look for the next opportunities as far as who benefits from AI. And then somebody that hasn't really benefited much yet, but should benefit massively over the next 2 or 3 years, which is who? AMD.
Theme still in play? Because I think it is. I know we're going to talk about it.
Yeah, well, it's not only is the theme in play, is the theme getting a little out of hand, right? I mean, that has been a serious point of conversation. The question whether this craze has hit bubble territory. I want you to listen to Goldman CEO David Solomon. He was in Italy today, and you'll hear what he had to say. Let's play.
Italy.
I'm not going to use the word bubble because I don't know. I don't know what the path will be. But I do know people are out on the risk curve because they're excited. And when they're excited, they tend to think about the good things that can go right, and they diminish the things you should be skeptical about that can go wrong. We're in one of those environments where people are out on the risk curve, and there'll be a reset. There'll be a check at some point. There'll be a drawdown.
David Solomon, what do you think about that?
That's no disrespect to David Solomon. I mean, that's the incredibly safe and correct thing to say. This is going to get out of hand. I've made this point 100 times. I'm not alone. Everyone has told you, Satya, Zuck, etc., has said the risk is underinvesting instead of overinvesting. And Zuckerberg even went a step further a couple of quarters ago, saying the amount of overinvestment that I could possibly do, I being Meta, is de minimis in the larger context of a multi-trillion-dollar company. So they're telling you they're going to overbuild. The only question, to David Solomon's point, is when, and to that effect, nobody knows.
Well, I mean, Lisa Shallot of Morgan Stanley weighed in on that. She said, what inning are we in? When it comes to market discounting scenarios, we believe we're closer to the 7th than the 1st. And we're starting to see cracks. She was talking about the CapEx boom. So she's like the first one that I know of, or in a very small cohort, who's come out and said, we're further along here than many people want to say. Right? I hear like second inning, third inning, first inning. She says, no, we're in the 7th.
Yeah, so I've never met Lisa, and I hope this comes out right. In the story I saw, she references cracks. I didn't see any detail about what cracks she's seeing. From my vantage point, all I see are CapEx commitments continuing to be large. Obviously, there's concern about companies investing in each other and whether they're using that revenue to buy products, a la some of the stuff that was going on in the 90s. But I haven't seen any cracks yet, and I'm certainly not. I don't think I'm alone.
No, but if she's saying, look, we've thrown around some really large numbers, and we're probably further to the end of the big investment than closer to the beginning. And then the other side of that is people saying, look, this rally is really on the legs of the CapEx spend. So if she's right, then the rally will be shorter lived than some people would like to believe.
I have no idea what inning we're in. I don't know if there's any real way to quantify it. I'm on the lookout for something that's going to tell me it's going to end. I don't know whether we're in the first inning or the 9th inning. What are the things that are going to tell me that this is going to be over? Well, CapEx is going to start coming down. Profit warnings are going to start coming. Companies are going to cease doing some of the things that they're doing now, like providing financing, et cetera. I have no evidence any of that's happening right now. So
by the time that happens, though, it's going to be too late.
Oh, that's not true.
Well, I
disagree.
Oh my gosh, dude! Is this guy new to the market? Is he like a brand noob investor? Are you kidding me? By the time Nvidia comes out and says, hey, revenue's looking a little shaky, dude, Nvidia's already going to be down 40-50% by that time. Are you kidding me? It's ridiculous. Like, I wish the stock market was that easy, where it was like, you wait until like you get the confirmation on confirmation on confirmation that numbers are going to be not quite there, and like that's when, dude, it's already going to be tanked before you get to that moment. So investors start to sniff it out early. That's why even with the stock like, let's say Palantir, as soon as investors start to sniff out that let's call it the revenue growth is at a place where it's not going to accelerate anymore, the stock's already going to be getting hammered. It will already be getting hammered. It won't be until you get the confirmation, right? Confirmation could send it down even more because it's like the group that maybe was trying to hold out thinking it wasn't going to happen. But the stock will already be down huge. So like a stock like Palantir would already get hammered, right? Then you would finally get the confirmation that like, oh yeah, growth is actually starting to decelerate. The stock gets hammered again because the second group that was hoping that it wasn't the situation, they start to realize, oh crap, this is a reality, right? And then the stock gets hammered again. So like if you've been in the market long enough, you know this. And I'm like, the fact that this guy thinks that's not a reality? Come on, dude. What are you talking about?
Warnings are going to start coming.
Scott's like, oh
companies are going to cease doing some of the things that they're doing now, like providing financing, et cetera. I have no evidence any of that's happening right now. So
by the time that happens, though, it's going to be too late.
Oh, that's not true.
Well,
I disagree.
The first whiff of somebody saying, you know what, we're going to spend less, we're a little concerned about the ROI and all this stuff, market's going to make a move.
Sure. Listen, if we've been using the 90s era as the blueprint, if you will, when the warnings started coming in early 2000, let me say two things. A, it is fair to say the Yahoos of the world, the high flyers of the day, sold off very hard by the summer and were down in some cases 50%. So without a doubt, what you're saying is accurate. For the broader market, which I think to some degree a lot of investors care about beyond the AI trade, In September of 2000, you were almost as high as you were in March of 2000 for the broader market. Now, again,
Listen, that's a whole different ball game. Today, the market's driven by all these stocks that are benefiting massively from this AI wave. Okay? That's what makes it very, very different. Back in the tech bubble days, you had massive market cap companies that were still very dominant. A lot of the oil and gas companies, the Procter & Gamble's, Johnson & Johnson, et cetera, et cetera. There were huge market caps that could hold up the market. The issue with the market now is that top of the market, the ones that really dictate whether the S&P 500 and Nasdaq go up or down, a lot of it is AI related, right? Supposed to be AI beneficiaries, companies that have definitely some valuation hope around AI is going to grow the revenues and things like that. So whether it's this fall or whether it's Q1 of 26 or at some point in 26, when the market has that time period where it's going to get tough, right? You're going to see the whole market get hammered when people get really worried about the AI trade. Not like, is nothing going to be there to hold it up, because almost all of those companies, pretty much all those companies, you can run through them. Like, they have a lot baked into them outside of really Google and Meta. Google and Meta are the two stocks that don't have much baked in. Amazon doesn't have that much either, but the rest of them all have some AI baked into those numbers. And some, obviously, like a Tesla's a massive number baker in her, right? And Nvidia's as well.
Yahoo's, Apple's of the day were down considerably, and that's a fair observation to make, that you're going to have to be very quick and nimble here. And that's
because there were some people refused to see the writing on the wall back then.
Let me stop you there and say, do you think people, after everything that we've been through so far, and presumably will go through over the next, I don't know, year, 2 years, 3 years, whatever it is, do you think they're going to be quick to see the end then?
No, which is why if I even said to you now, I can guarantee you this is going to end badly, would you change your investment behavior today? And people would say, hell no.
But I agree, and I think on the halftime show, you guys talked about this for a minute. Everyone agrees it's good. Well, I shouldn't say everyone. A lot of people agree this is going to end badly. You can't invest this much, this rapidly in a new technology and not have some form of overinvestment, malinvestment, et cetera. In that sense, it's going to end badly. But again, the seeds of the entire world that we know today, aka the internet, was sown during that telecom overbuilding phase. And there was a lot of, I think the stat was by 2002, 85% of the fiber cables that had been laid were still unused by 2002, 85%. I don't know if that's 100% accurate, but that is a number that gets tossed around. Do I think all of the data centers that we're building and all of the power provisions that we're building right now are going to be used 5 or 7 years from now? Probably not. But the question becomes, what do you do with all of this? And I'll end with this, and I'm sure we're going to broaden out the conversation. If you think about the invention of refrigeration, you could have invested in GE or whoever's making the refrigerator. But thereafter, in the years after the invention of refrigeration, you know who did very well? Ben and Jerry's.
I understand, but you know, some are going to say you do what they've said to do in the past. You dance until the music stops.
We've talked about this before, yes. But for investors...
I'm not saying that, but that's what you hear time to time, because people are so enthusiastic about what's happening in the market. They don't even want to see what could happen on the other side. You ride it, and the thing tips over at the end. You're like, well, should have saw it coming. Didn't.
Well, listen, hindsight's 20/20, and I'll just end with this. It's a bull market when you're invested. It's a bubble when your neighbor is.
All right. Then there's credit. The alt managers are getting hit this week on concerns about another area of the market in particular. Our Leslie Picker, following that money for us, joins us now. Hey, Les.
Yeah, this private credit situation is actually really intriguing in regards to what is this like. I think it's very interesting. I think it's something that definitely folks should be paying attention to right now.
Hey, Scott, yeah, it's the private credit side of the business that has seen a real sentiment shift. Apollo, Ares, Blue Owl, and KKR seeing significant declines week to date, while those more exposed to private equity, think TPG and Carlyle, well, they've held up okay. 2 high-profile bankruptcies in the auto finance space leading to a broad-based sell-off in the publicly traded alternatives firms. Tricolor and First Brands bankruptcies, each within the last few weeks, have shed a new light on the risks of over-leverage and subprime borrowers. Hedge fund manager Jim Chano slamming private credit in an interview with the Financial Times, saying, quote, "I suspect we're going to see more of these things like First Brands and others when the cycle ultimately reverses." He said the $2 trillion private credit sector is akin to the packaging of subprime mortgages during the 2008 crisis because of the, quote, layers of people in between the source of money and the use of money. Typical direct lenders sit toward the top of the capital stack, meaning they would get paid back before equity and other layers of debt in a bankruptcy, Scott.
All right, Leslie, thank you. That's Leslie Picker setting that up for us. Let's bring in now JP Morgan's Stephanie Aliaga and see.
Now, you may say, private credit, okay, boo-hoo. Let's say things go south there, right? I'm not exposed to private credit. Why does it matter to me? I'm an investor of NVIDIA stock. I'm an investor of Meta stock. I'm an investor of an index fund, right? How does it affect me? Listen, if you start to have major delinquencies, major issues, major not paybacks in private credit, right? The private credit folks the backers of private credit start to get hit. When they start to get hit, they're not as likely to invest into new future private credit things, which means more things that need private credit could go under, right? Additionally, they're not likely to invest in the markets. They're likely to play safe. Additionally, if they're really getting hammered, they have to start to liquidate other assets in other categories. A la, could be real estate, it could be stocks, it could be bonds, things like that, right? To go ahead and fund something that's going on in their private credit problems. That leads to more fear in the market, more downselling, which leads to more fear, which could lead to worse financial results, could lead to recession, could lead to more problems in private credit and a whole explosion. That's why it matters, okay? So now, as long as you own great companies, like they'll make it through that short-term time period, whether that lasts 3 months, 6 months, 12 months, 18 months, 24 months, they'll make it through just fine and they'll be okay. But we can't act like we wouldn't be very negatively affected. This private credit situation, and it might not, but if it gets ugly, we're all going to get hit. I'm going to get hit. You're going to get hit. All of us are going to get hit, okay? So just something to kind of keep in mind there.
NBC contributor, Capital Area Planning Group's Malcolm Etheridge. Dan Greenhouse, of course, is still with us. It's nice to have you here on set. Steph, what do you think about what you've heard so far?
I was waiting to chime in when it comes to the AI spending boom, so I'm really excited here.
Okay, go ahead.
Let's just look underneath the hood of these big numbers, because they're starting to feel a little hyperbolic. Okay, hundreds of billions of dollars being spent, maybe $1 trillion being spent, or a few in a few years. Underneath the hood, though, we've had a significant shift in the paradigm for computing. Compute is becoming one of the world's most critical resources. Now, as models are getting more useful and we're using more and more of them, the reasoning models that we're using require a lot more compute. In fact, NVIDIA estimates that giving a really challenging question to a reasoning inference model will require 100 times more compute than traditional single-shot inference models. Adoption is scaling rapidly. 10% of firms now adopt AI. That's expected to grow. 10% of the world's population now uses ChatGPT weekly. We're in the very early innings here, and companies are realizing, these cloud providers are realizing, their ability to even be in the market when it comes to AI demand over the next decade is going to be really reliant to their ability to get a hold of the resources they need.
All right,
not only on the inference, but also training.
All right, hang on 2 seconds. Sorry. Malcolm, hang on for me just a moment. I do have some news on auto tariffs. Phil LeBeau has that for us. Hi, Phil.
That's a long ways off, Scott. You can report nothing's been announced.
A lot of the headache around this had you just done this.
Manufactured here in the United States. Even with a 25% tariff for a vehicle coming from Mexico, it's still a profit maker for the automakers. It's not like they're all of a sudden going, oh, we can't sell that here. Would they like to have the lower costs and not have to pay a tariff? Absolutely they would. But it's not going to stop
a private credit issue.
By the way, as far as that goes, I don't think Elon's going to be too happy about this.
Phil, thanks. Appreciate the update.
Yeah.
Stocks are on the move, as you can clearly see. We'll follow them for the remainder of this program. Malcolm, I go to you on the market. Concerns about either an AI bubble or a private credit issue that is yet to show its...
And that's the issue. You send... Like, think about this, right? We talk about the top of the market and these AI stocks and all this, right? Something like this, you could say, okay, it's going to benefit Ford, GM, these sorts of companies, right? So their stock's going to go up. Tesla might go down because it's something that hurts Tesla, right? If anything, they could benefit massively from these other automakers being hurt. And if they're not hurt, then Tesla benefits. Well, here's the deal. Tesla matters significantly to the S&P 500, significantly to Nasdaq. So if that stock goes down, even if Ford and GM go up, it doesn't matter. Like, Ford and GM are just such small market caps when you compare them to Tesla, right? That's where you run into problems in this market and why it's very different than, let's say, 2000.
Face.
1999, whatever.
I am far more concerned about a private credit bubble than I am an AI bubble, and I think maybe we're thinking about the wrong side of it. I think that Dan made a really strong case for the fact that we're way earlier in this baseball game, to keep the analogy going, than some analysts seem to believe that we are. And the reason I say that is if you just consider that a lot of the tools using AI and building AI right now are solely in the workplace. We still haven't seen much creep over into the world of the consumer, where that really tends to be that shift. That if you think about the 90s shift that happened with the internet, a lot of the bubble that happened was all around consumer websites and folks trying to bring things to the consumer a lot faster, a lot cheaper using the internet. And so we're still completely in the enterprise, or at least almost completely in the enterprise. And so I think that alone tells us that we're so far away from this being a bubble that a lot of the CEOs we're talking about are right, that they're way more in danger of underbuilding than they are over. And Dan brought up Mark Zuckerberg earlier, so I'll bring up another one of the CEOs who's in this conversation. Satya Nadella told us way back in January, I believe it was, he's good for the $80 billion he's on the hook for as far as CapEx is concerned, and they anticipate increasing that going forward. So I'm inclined to believe him.
I want to get your take, by the way, on the idea of private.
So to push back against Malcolm there, something very important I don't think he's thinking about, that he should be thinking about, in my opinion, is the gap between going from the enterprise into the consumer space, right? And an average person using AI on a daily basis for random stuff, right? That is nothing in relation to the workplace, right? First off, there are some use cases where people are using this on an everyday basis that doesn't have anything to do with work. A good example of this would be people have been looking for, like, I was even talking to a couple when I was on vacation a few months ago, right, in Mexico, and I asked them how they found this particular resort we were staying at. And they told me they ChatGPT'd it, right? And they, looked it up, or they asked it, where some of the best resorts were, blah, blah, blah. And that's a good example of, like, it has made it outside of just the work profession, right? I've also heard people using ChatGPT as like a therapy type thing, right? To help them with problems and stuff like that. It's a good example of, like, using it outside the workplace and not just being in the workplace. So let's not assume the only people using ChatGPT are just for professional purposes or college kids or something like that. It's gotten already bigger than that, right? But the other factor is, between going from where we're at now into a massive consumer product where it seems like everybody uses it, kind of like social media, it seems like almost everybody's on either Facebook or Instagram or X or Snapchat or something, right? How do you get it to be like as big as social media is? You need some killer apps, as they call it, right? Some things that my mom all of a sudden's like, oh, I want to use that. My dad, right? Like, people that are baby boomers are like, hey, I want to use this AI thing, right? Like, we need that, but how long is it going to take? We don't know, right? That could be years from now. Could be months from now. Could be years from now. Could be a decade from now. We don't know. That's the whole point, right? And so between getting there and getting there is a long way, right? I mean, even if you look at people shopping on the internet, right? I mean, I think we first got internet in our house. I think it was 1998. We got AOL dial-up, right? We had AOL dial-up for years, and if you know about those days, you know about those days. Brutal, like, how have we come a long way, right? But people weren't really shopping on the internet for a long time. Like, people didn't really get confident really shopping on the internet in any sort of substantial way until we were deep into the 2000s and then into the 2010s, right? And obviously businesses like Amazon boomed and many others, right? And Shopify obviously has taken off over the last 10, 12 years and all that sort of stuff. But even shopping on the internet for a long time was like, people didn't trust it. They thought it was weird, right? It was sometimes more expensive, many cases, right? And then I feel like late in the 2000s and into the early 2010s, that's when, so stuff takes a long time. It wasn't like, oh, we got internet in our house in 1998 and suddenly my parents were ordering a bunch of stuff online. No, if they ever ordered something online, it was very few and far between. Like, I remember one of the only things I remember them ordering is this specific type of coffee they liked. Other than that, like, they never ordered anything online. Nowadays, they order tons of stuff online, right? And then as far as me, I started ordering stuff online when I was still in high school, which was like, we're talking, this is like 05, 06, 07. I would order like football cleats and football gloves and stuff like that on the internet. And so, but that's a long time from 1998, right? And keep in mind, there was a lot of people that had internet even in 95. So, these things take a while sometimes.
Credit issue somewhere down the road, today, tomorrow, who knows when it is. You do have Solus Alternative Asset Management in the name of your firm. How are you thinking about this?
So I think this conversation is not as holistic as I think it should be, and with the caveat that we don't do a ton of private
Oh
credit.
my gosh, my trash barrel just went into the street.
Solus is not Ares, et cetera, et cetera. I come down on the more favorable side of this conversation. I don't doubt that there's
the wind starts kicking up here in Vegas, and especially where I live right by a mountain, and the wind starts kicking up. My trash barrel just went into the street, and the way people come flying around the street at 100 miles an hour, somebody might hit that barrel. But to be fair, maybe that would teach him a lesson. But anyways, I might have to get that barrel.
Being done that's probably incorrect, for lack of a better word. And the quote before was from Jim Chanos, who's the best, was when the downturn comes, we're going to see some more problems. Of that, I have no doubt. But the key part of that...
Jamie Dimon's talked about the same thing, by the way.
Listen, when the downturn... But the key part of all these sentences is when the downturn comes. Good luck predicting that. But about private credit, I mean, listen, the idea is you're providing a loan to a company, you're doing single manager, single borrower, level of due diligence, you have a relationship with them. These are all well-known talking points, but you have a relationship with the borrower that you don't have in what we call the BSL market, or the broadly syndicated loan market, and you can more appropriately work with the borrower if issues arise. And so we keep talking about some of these, some of the defaults that arise, and everyone's going, oh, there's a faulty loan to this company. The default rate in the bond and the loan market is in the low single digits. There has been no widespread defaults, either on the private credit side of things. Granted, there's a mark-to-market issue.
Of course there hasn't, but the whole point is that people look at what's taken place with these two companies and say, if you get a deeper economic slowdown, you could have a lot more.
Yes,
at a time when many people have been pushed into these assets in the first place who never had exposure to them to begin with.
Well, listen, someone was making the loans. They were in the traditional loan market. They were in the bond market. Now they're being done by the private credit companies, Ares, Carlyle, et cetera. And the better question is, should I whichever investor we're talking about, have exposure to these, for lack of a better word, highly illiquid, highly specific products? That's a good question to have. I just reject the wholesale conversation about all of this is being done by idiots to idiots, and there's going to be losses all over the place. You mentioned before, when there's a downturn, there's going to be losses. There's going to be losses in private credit. There's going to be losses in loans. There's going to be losses in the equity market as well.
I don't think anybody's saying by idiots to idiots. I don't know where you're getting that
from. What I mean is people sometimes we're on panels with people here on the network, and they talk about private credit as if loans are being issued willy-nilly and due diligence is not being done. These are the people running Ares and Blue Owl.
No, they're just saying that
No, to push back against that, you don't know. You don't know until the situation happens. I guarantee you, if we went back to 06, right, 05, 07, people would have thought they're doing their due diligence on all these home loans. Like, there's no issues in the mortgage market. Like, everybody's doing their due diligence, right? And then we found out, no, that actually wasn't the situation. Because the issue is you get a lot of middlemen who make commissions, okay? And these middlemen will do whatever it takes to sometimes get loans done because it means that they make a lot of money. So if they might get some sort of fee structure where if they can give a business or an entity a $100,000 loan, maybe they get 1% of that or 0.5% of that or something like that, right? Or 5% of that, whatever the amount is. And so they're much more likely to fudge numbers, to have some errors, omissions, things like that. And so just understand, you don't know how much due diligence was done until you get into a recession. That's when you begin to realize, oh crap, no, they actually weren't doing what we thought they were doing.
The area itself has exploded in growth. You're talking like $2 trillion in assets now.
But the high yield bond market, for instance, and we were just talking about this the other day with someone, is 1.4 trillion in size. The listed index eligible bond market is 1.4 trillion in size. It was 1.4 trillion in size almost 10 years ago. The bond market has not grown in a meaningful way. The loan market is a little bit larger. It's been trending up for 15 or 20 years. But my point that I made before, which I'll reiterate, is a lot of those loans were in the regular way bond and loan market, and they're not now. They're just being done by Ares, by Blue Owl, to the same people, just through a different mechanism.
Okay, back to the equity market.
Sure.
Stephanie, been a pretty nice and broad month. Right, you look across the board, Nasdaq up 6%, the S&P up 4.25%, the Russell 2000's up better than 5%, and the Dow up near 3.5%. What does that tell you about what's in store for the next few months?
Yeah, and if we even broaden that scope, you have international equities, year to date, outperforming U.S. equities by 1,000 basis points. What we think is so important for investors to really hone in on right now is diversification has worked really well for investors this year, particularly given dollar weakness. We think moving forward, that is going to remain a key course of action here. You have valuations in U.S. equity markets at their highest since they've been in the 1990s. Now, that's not flashing red. There's very good reasons for elevated valuations in U.S. stock markets, but it does mean that if you take the medium or long-term perspective, your expectation of returns in U.S. equities should be more moderate. So we think looking internationally makes a lot of sense, hedge some of that currency exposure, and then look at diversifying your diversifiers in alternatives, making sure that you are, of course, leaning in on
Her hair looks good. Must have taken her a while.
high quality managers to help with some of these more riskier parts of the alternatives markets. But we do think there are really good ways for investors to both boost income in portfolios and help diversify portfolios against pretty concentrated public equity markets.
Malcolm, the broadening over the last month, does it continue?
I think it could continue short term, but I think realistically, all the chips push right back into those Nasdaq stocks, the chip stocks, anything hyperscaler that's right now building out AI capabilities, the Metas of the world, the Microsofts. Apple, surprisingly, has been leading the pack the last quarter. I expect for Apple to continue to push because they're showing a commitment to figuring out a way to get in front of the next thing. We've heard so much from smart minds that the AI conversation is going to change the way we interact with our devices. Maybe we don't even need a device anymore to interact with AI going forward. And I think Apple is showing that it's committed to getting in front of that conversation now. And so I think that realistically, it's going to be the usual suspects that carry us through the remainder of the year.
Guys, we'll leave it there. Malcolm, thanks. Steph, thanks. Dan Greenhouse, we'll see you soon.
Apple?
All right, coming up, let's send it to Christina Partsenevelos for a look at the biggest names moving into the close. What do you see?
Wynn Resorts down about 6%, with that stock pacing for its worst day since April. Shares of Las Vegas Sands also down about 7%, and those drops are really on news of extreme weather coming to Macau, a special administrative region in China. The storm could actually disrupt the region's Golden Week, during which it welcomes thousands of visitors. Switching gears, healthcare stocks also.
Okay, so okay, listen, Wynn stock's been red hot. We all know that. If anything, it's been blue hot. Like that stock's been an incredible performer for the last 6 months or so. But listen, I understand like people are concerned the weather's coming, right? So the numbers might not be as good for Golden Week, blah, blah, blah. Okay, listen, let me tell you a little something about human nature. If the rich Chinese dude wants to go gambling in Macau, he's going to freaking go gambling in Macau. If it's not during the storm, he's going to wait a few weeks or wait a month or two. He's going gambling in Macau, okay? He's going to drop his $3 million at Wynn. Like, that's just what's going to happen. So, like, could it affect the numbers for that Golden Week? Sure, that's perfectly fair. But if you think, like, these guys that want to go to Macau and ball out are just going to be like, oh, darn, I can't go that week, I'm not going to go at all. Of course not. Of course not. What are we talking about here, man? Like, what? Like, if a dude wants to go to the strip club and the strip club's closed because it was raining out, right? It was a big thunderstorm. I don't know, electric went out at the strip club. He's going to go to the strip club probably a few days later, a few weeks later. Like, dude, like, we're talking about humans here. Like it just cracks me up, man. Like, this is where I call it, like, trying to think too intelligent in the market and thinking, like, overthinking these things. And I'm like, okay, yeah, so Golden Week's not as good because a big storm came in. By the way, oh my gosh, my trash barrel's rolling down the road now. Oh my gosh. Yeah, people are still going to gamble, okay? If it's not this week, they're going to go in a few weeks or a few months. Like, they're going, okay? All right, guys, appreciate you joining me as always. Thank you so much for being here. Don't overthink things, okay? Appreciate you for joining me. Pin comment down there today if you're looking to apply to join my private stock group, private wealth group, get access to all my course curriculums, access to my private Discord chat with the 6, 7, and 8-figure members, access to 1000xstocks.com. That will be the first pin comment down there. If you only want access to see the stocks I'm buying and selling and how I build a portfolio each week, including the stocks I was buying and selling today, that will be the second pin comment down there, and that's also linked in the description area, and that is to join my Patreon. Those are two very, very different things, okay? All right, guys, much love and have a great day.